Hi everyone, this is Rob Roy, and welcome to the Elliott Wave Options U.S. Market Update. As we do each and every week, we show you the stocks on your screen that'll be featured in this recording. And as a reminder, if there's a particular stock you're interested in, you can go directly to it using the chapters feature in this recording. All right, let's get to the chart of the markets. Last week, we showed you how we had the two thumbnails. Did you miss this buying opportunity for a rally? And then our target was at 690. It's exactly where we went. And then last week I posed the question, but can it hold? And so far the answer has been no, kind of. We've come down and on the low today, and we are recording this during market hours on Friday, so things could change a little bit into the close. But ooh, look at that price right there on the SPY. You hear the expression, the devil's in the details. Maybe the devil's in the market right now. Uh, anyway, we've had this big move to the downside here, but all we've done is correct. We got too vertical, too fast. I don't like the gaps. You know that if you watch. We got too far from the 10-day moving average. All the things that I talk about week in and week out are all coming to fruition here as we are retracing that vertical move as we broke above the 675 level. So then the question was, can we hold there? And we've moved lower down here. And as I said, holding the 50-day moving average, a little bit more support down at 660. This is a pretty good corridor of congestion here. We talked about this kind of sideways stuff in that event that we did on trading for income. A couple of weeks ago, we had that free event. Now we have another one I'd like to call your attention to. This one's really going to be cool. On Tuesday, we have another event, and this is predictive trading, and it's going to be wrapped around the AI. And you hear me talk about this software all the time. The CEO of the Hub organization is going to be on this. He's the one that employs the data scientists that create the AI signals. So if you want to learn more about how AI is affecting directional trading, this is the event for you. A rare opportunity to get a chance to talk to him, ask him questions, etc. So it's going to be Tuesday at 8 p.m. Eastern time. Once again, it's free. So sign up. You can look at the link on your screen. Again, rare opportunity to take advantage of it. And in the meantime, before that event, if you haven't already, go to hub.com, HUBB.com, get a free copy of the software, which you'll undoubtedly be talking about. You get the Elliott Wave signals for free. There is an opportunity to subscribe to the AI signals if you want, but the software and the Elliott Wave signals are free. All right, so coming back down to the chart of the markets, holding this 50-day moving average is going to be key, but it's not that crucial. As I said, there's support at 660 if we fall from there, but we wanted to know if it could hold. This is a pretty healthy correction, in my opinion. I don't think there's anything nefarious going on. Also talked about how the government shutdown was eventually going to start to affect the markets. We're in the longest shutdown in history now, and more paychecks being missed. We had some effects in the bond market as well as here on the VIX, which I'll talk about in a moment. We had the consumer sentiment report come out. I'll show you that when we get to the bond market, which was kind of concerning on the headline, creating a little bit more volatility. As a reminder, in the VIX, this upper line is from the weekly chart. Also talked about a slight incline in higher lows on the VIX. We did get the breakout on that tariff 2 day that we had, a big spike up here, but right back down. Unable to break below 15, just has been the floor on the VIX this year. Never got down to 12.5, at least not yet. And you have to wonder, with this slight incline here on the weekly chart, is volatility here to stay? The Fed kind of put a fly in the ointment, if you will, with taking off the thought that December was already on board for a rate cut and saying, no, it's not guaranteed. They did give us the October one. Let's just go ahead and go to the bond market with everything that I'm talking about. TLT here, you can see that what the comments from Chairman Powell, and I thought it was a little bit misleading from his interview that he did a couple of weeks ago, where it made it sound like we're wrapping up the reduction of the balance sheet, the shrinking of the balance sheet. It implied, in my opinion, from what I heard, everybody hears things differently, that they were about done. And then when the Fed meeting comes out, he's like, no, we'll complete that around December 1st. So we had a little bit of a bounce to the upside in prices. Reminder, this is TLT, so this is prices on the 20-year. Prices and yields move inversely. So when prices were going up, yields and rates were coming down. Now we're doing the opposite. Prices are coming down, yields and rates are moving higher. But we also fulfilled the triangle rule. We have a triangle here, symmetrical triangle. We broke out, came right back down, tested the point of the triangle. We're right at the 50-day moving average. At this point in time, we've pretty much retraced from a closing wave 5 back to the previous. We've done everything Elliott wave base we can on TLT. Followed the 5-wave pattern rules, followed the triangle breakout rules. It's just now, where do we go from here in the bond market? And we talked about that sentiment report. Now, this was the University of Michigan sentiment report. So as we put the slide up on the screen, the headlines are kind of daunting there. Near's lowest level ever during the government shutdown. And that's what I was talking about. I said that the government shutdown would eventually start to affect the markets. I didn't think it would short term, but it's affecting consumer confidence. Clearly now, in fairness, the University of Michigan report is a smaller sample. We don't get the government numbers because of the government shutdown, so we don't see what their numbers are on sentiment. But going back and taking a look at the bond market here, we have to wonder if we're going to start seeing concern over consumer spending into the holiday season being priced in to the bond market. I think that's where it could be even more effective. You're seeing the headlines today of flights being shut down, lack of TSA agents, lack of air traffic controllers. So is that going to be a problem moving into the holiday season, holiday travel? Around Thanksgiving or even Christmas, if the government shutdown continues? All those things, now it starts to become something that we need to talk about as far as an issue with the markets, in my opinion. So taking a look at TNX, there's yields and rates going back up. I do think that the Fed created part of this by saying, no, December is not in, it's not necessarily, it's something that'll be talked about, but no guarantee of a December rate cut. The market had already priced it in and was kind of leaning towards the possibility of a 50 basis point cut in October. None of those happened, so yields and rates have turned around and gone back to the upside. And what that's done is create a little bit of a bid in the dollar. So far, so good. We ran up here. We're still in the Goldilocks channel here, but you can imagine that rates moving back to the upside, withdrawal liquidity, et cetera. We're going to get a little bit of support to the dollar. And we did. We have this zigzag pattern here and a triangle. So we have two Elliott wave corrective patterns within this sideways channel, which is a pretty unusual setup. But we broke out. The B wave is interesting because 38.2% corrective moves in the B wave gives you expectations of a 61.8% extension on the C wave. But if you go down to 50%, then it gives you 100% expectation. Well, 44 is dead in between, right? Smack in between 38 and 50. So where does the extension level go? For now, you would expect that there'd be resistance at 61.8 is a pretty strong fib level. So we've had that. So we've ticked down, but we're still above the 10-day moving average. So maybe we still do break out and move up to this level. And if this wave 5 is complete to the downside, which it appears it is, since we're in corrective patterns following the end of a wave 5, we should move back up towards that previous 4, which means that the dollar should continue back to the upside and hit that 100% extension, which is pretty close to where that wave 4 is. I think we could handle that. You've heard my concerns. We don't want to see the dollar get too strong, or it will affect next quarter's earnings, as companies will be saying, oh yeah, the dollar got stronger and the exchange rate affected our earnings. It gives them an excuse, whether or not that had anything to do with it or not, but it is legit. So that's why I'm concerned about the dollar going too much higher. I'm pretty picky, aren't I? I didn't want to see it go too much lower. I don't want to see it go too much higher. I like this Goldilocks channel. I wanted to stay there. We'll see if we continue to get that. Looking at some of the rest of the charts of the market, looking at the DIA, we had this drop down here, very similar to what's gone on with the S&P. We had the gaps here on the DIA, even more unusual than gaps on the SPY. We haven't quite made it down to the 50-day moving average yet, so perhaps that's where we're destined to go on the DIA. We have support here, so 460 as a support level on the DIA correlates to that 675 level on the SPY, which we broke and tested the 50-day moving average. So now we look at 660, but we haven't gotten down that far yet on the DIA. So a little bit of outperformance here, but all the markets moving lower. Then we go to the Qs. We take a look at the Qs, also down, testing the 50-day moving average. Could argue that this one was even a little more vertical on this breakout above resistance. We had the breakout patterns. We had ascending triangles. They broke out, gapped up. Don't like that. Don't like the separation from the 10-day moving average. Don't like the fact that things go vertically up because they oftentimes comes vertically back down. Every single one of those rules we talk about got fulfilled. Came down and filled the gaps, came down and closed the gap with the 10-day moving average, and what goes vertically up oftentimes comes vertically back down. Exactly what happened with the Qs. And now we're testing the 50-day moving average, and it has its own little corridor here of congestion. As long as we stay above where this B wave is, you could maybe see an extension, but I think it's important to note that with that B wave around 38.2, your expectation is 61.8, and then the extended level. And I talk about this, that oftentimes a C wave will extend when it's in a wave 3, but it already has. And a second extension doesn't happen very often. It does occur, but not very often. And with this move down, it doesn't seem like that's going to happen. So when a C wave ends, what normally happens is retrace the entire C wave. So the 50-day moving average may not be the final stop on the Qs, is what I was mentioning. Now, on the short term, we are a little oversold. So it works both ways. You get too far from the 10-day moving average on the upside. You get too far from the downside. Reverse back. Maybe we're due for a reflex bounce at the beginning of next week. We'll see. And then looking at the IWM, this one makes sense as rates are ticking up, just as we were getting a bid under the IWM as rates went down. Now that rates are ticking back up, it's the exact opposite. We've talked about this numerous times. The small caps, the Russell, IWM is the most rate sensitive of all the markets because these are small companies. They need to borrow money to grow and expand, et cetera. So the fact that rates are ticking up, is this the leader is what I'm wondering now. There was a time earlier in the year where a lot of people said they really liked the IWM. They liked the Russell this year, and it has had a pretty good move. But it's broken the 50-day moving average. So my question is that giving us more of a signal to its relationship to interest rates with the bond market, or is it the fact that it's viewed as a good indicator of risk on, risk off in the markets, and the markets are less susceptible to risk? We know that the high beta stuff is being taken down. We'll look at that when we get to individual charts. But from that standpoint, I think you can make a case for both of those arguments. Look at natural gas. We have had a little bit of a bid here. It's going to get awfully cold. And maybe even though the Farmer's Almanac, and I saw that today they're going to stop publishing it. It was like, what? That's what farmers have relied on forever. But that was a news event today. But it did show that colder than expected winter this year. Could that change the supply demand dynamic that we've been talking about that's occurred in natural gas? I don't want to go through it all again. You can look at a past recording and see it. Movement back to the upside here. The only question is, do we make it to 15? We're a little bit above the 10-day moving average. I think we could. I thought we were going to do it back earlier here, but maybe now's the time when we have enough bid in natural gas to overcome the fact that we are awash in supply. We'll continue to watch that. But for right now, it looks to me bullish up towards 15. Then I think we have to have a reassessment, see where we might go from there. At that point, the dollar, cue Led Zeppelin, song remains the same. Not much else to say. Staying in this big trading range, hovering somewhere in the 75 area. We did have a triangle. We broke out. We did a good job of exiting that in our volatility portfolio at EWO Trader, because I was afraid that if the oil came down too far, OPEC would announce a rate cut. They are a production cut. They didn't, but we still bounced back up anyway, right back to the point. We've got another triangle, but this one's smaller. So we could break out again in oil, but it's not going to be a move of significance. I don't think that's one that a straddle or strangle has enough move to generate a gain. So I think we just watch and see what happens. But it's been quite normal there. As we go to the metals, GLD getting a little bit of a bid back today. Potential consolidation here, and there's the rules. We started up okay, a little more than a 45-degree angle. Then we went vertical, and we got too far from the 10-day moving average. All the stuff I just got done talking about. So that corrects right back down, back to the 10-day moving average. We corrected the vertical move. Goes vertically up, comes vertically down. We've had a nice consolidation in this triangle, and that's what GLD loves to do. That's why I watch it so often. It likes to break out and consolidate, break out and consolidate. So it's consolidated, due to break out again. But remember, even though that wave 4 is labeled and it's right at a fib level and we're right above the 50-day moving average, you can make a lot of cases for the fact that gold's getting ready to break back to the upside. And maybe it does. It's got a descending triangle, which, as I've talked about numerous times, does not guarantee a downside breakout. It could break either direction. But if by chance gold were to break lower again, then we're coming down probably into this 330 range because we had a fairly vertical move up there. If we break below where we are at support now on the GLD, there's very little in the way of resistance on the way down. And that's why we could get down there rather quickly. But we are trying to break higher, likely to be back above the 10-day moving average into the close. We'll see. Silver following suit a little bit, not quite as significant, but look at that triangle in SLV where we have a descending triangle on GLD. We've got a really nice symmetrical triangle on SLV. It's not that large, but the triangle on GLD is not that large either. So we're looking for a move in the metals, a breakout move. We don't know which direction either of them are going to go. It isn't going to be a big, huge move, but some sort of a directional move is coming here on the metals with these patterns. Both of them, with their 50-day moving average test, wave 4, and it would kind of make sense that money could move back into the metals, I think. The area that's really of concern is in the area of crypto space. We talked about this, at least as evidenced by BITB. If you watch IBIT or some of the other ETFs, I show this one. They're all very liquid now. But with BITB, we said that 60 needed to hold, and it really tried. We had these multiple tests of it. I mentioned my mentor talking about the third time's the charm. What happens on a third test normally carries over, at least on the short to intermediate term. We broke below 60. We said that when we break 60, we're probably coming down to 55 very quickly. But now it's even more concerning or nervous time, I guess, if you're in the Bitcoin space. If 55 doesn't hold, at least again on the BITB, there's nothing to stop it from going all the way down to 45. That move from 45 to 55 was quite vertical here. So once again, no resistance on the way down. We are a little oversold. We're a little bit below the 10-day moving average. But if you're long Bitcoin, you do want to see the BITB hold 55 and bounce. And it's got some work to do. We got to get back above 60, back above the 10-day moving average. And if you're considering any sort of a long rally into the end of the year, back above the 50-day moving average too. So you can see there's a lot of work to be done on Bitcoin before you can start being excited from the long side again. And then Ethereum, same thing. We had this corridor here. You could have argued 27.5. You could argue 25 as support levels. So I drew it as a corridor. We broke below it, a little bit below the 10-day moving average here, but same scenario. There's nothing to stop Ethereum from coming down here to 20 because that move from 20 to 25 was straight vertical. The only thing is that maybe we get a little bounce because we're a little bit below the 10-day moving average. Maybe we get a little oversold bounce, but we seem destined for 20 now on Ethereum, and then we'll see where things play out from there. But some of the wild forecasts of rallies into the end of the year, boy, if those are going to come true, the crypto space needs to get its act together really quickly. But so far, not occurring. Now let's go to stocks of interest and take a look at Amazon. And while you look at Amazon, I actually talked about this during Trade Finder on Tuesday. And if you're not signed up for Trade Finder, you can sign up with the link that you see on your screen now. We do it every Tuesday at 2 p.m. Eastern Time. It's a live show. We look at the markets. We look for trade ideas. We have a live Q&A. Great community that's involved there. So if you haven't signed up, join us. I always talk about it's my favorite show of the week because the questions that people ask are unusual and different. It's not the same old symbols every single time. In the audience, you guys can interact with each other through the chat window and stuff. So it's great. So sign up and join us for this week's Trade Finder. The reason I bring it up now is with Amazon. I actually talked about that during Trade Finder this week, where we had the big move up. So we had the good earnings report. Then we had the AI deal. So we go boom, boom. You know the story here. Gap up. Too vertical, too far from the 10-day moving average. And so here was Tuesday, and I commented that I bought puts on Amazon because of the rule that it follows. I mean, you know, if you're going to talk about rules, you got to back them up. So I did it in my personal account and mentioned it on Tuesday and said, it may be a one-day trade. It's a 1 to 3 day trade when you go so vertical like this. You fade it, you go the other way. Because of that rule, when things go vertically up, especially when they're accompanied by gaps and especially when there's separation from the 10-day moving average, it's going to correct. It's very quick. It doesn't mean that we're coming down a long time in Amazon. It's just correcting the froth, the overbought part of it is all. So you can see what happened on the next 3 days. So that's something that a lot of our subscribers at Evo Trader have picked up on, and they talk about, they ask it in questions quite often. Now, the wave 5 is in the middle of the tap box, so some backing and filling here, but we could easily bounce back up a bit. This was, again, just a correction. It's a very short-term thing of an overbought scenario. It works the same thing if you're oversold. So, again, I think some consolidation, as long as we hold above 240 here on Amazon, I think you stay long there. Going to take a look at, let's just jump to Tesla right now because we all know the news there. They approved Elon's $1 trillion pay package. It isn't that they're just handing him $1 trillion. I think the media misleads that a little bit. No doubt it's a heck of a lot of money, but it's packed with incentives. There are a lot of things that targets that he has to hit, things that he needs to accomplish. And if he does them all, yes, he's going to be well rewarded for it. He's already well compensated. I watched somebody yesterday that went through it in detail, and their assessment was, you know what? If he can pull off all this stuff, he deserves that amount of money for the benefit that it's going to bring to not just Tesla, but a lot of other companies as well that do business with Tesla. Anyway, as one person's opinion. But market ticking down a little bit again, at least at this point. It's a negative tape, but we are holding the 50-day moving average. It is a lot of money, but I think Tesla looks fine as long as we hold 400. So that's going to be your key. We're right at the 50-day moving average. That may hold, but you're kind of in between, sitting on your hands now on Tesla. If you want to go long, let it break back above 450, get back above the 10-day moving average, back above resistance, and no reason to jump in before then because the 50-day moving average may not hold. We may come down to 400, and that's such an important level to hold because if we break 400, look what happens here. So we had 350, again, a quick vertical move. If by chance we broke 400 to the downside on Tesla, we're coming down to 350 rather quickly. So 400 is your key. But let's see if the 50-day moving average can hold. But again, a long position, I think you got to wait till you get above there. And then look at Alibaba. This is one of the stocks that y'all requested from last week's recording. And as a quick reminder, we have a free giveaway that we're doing every month this year where we're giving away one of our free or one of our level 3 subscriptions for free. It includes, it's actually 4 portfolios, but it includes the time strategy, which is what we talked about in the trading for income events a couple weeks ago. That's the sideways. The volatility portfolio is the one for triangle breakouts. You've seen enough of those. And then the AI impulse, and you're going to get a lot of information on the AI stuff if you join that predictive trading event on Tuesday night. Package those together. There also, it comes with a speculative portfolio, which is a portfolio that we find ideas that don't necessarily follow all the specific rules in these portfolios. So it's worth thousands of dollars. We give away one free every month. All you have to do to register for it is post a comment underneath this video, and you're automatically in the drawing. So if you're a subscriber, make sure you're a subscriber. If you're a subscriber and you post a comment, you're in the drawing. I wanted to thank everybody for all the Chuck Norris one-liners. I always get a kick out of reading those. This is the last day of last week's, so next week we'll announce the winners, because we did a separate pool for if you wanted to put in a Chuck Norris one-liner in last week's recording. That was a second giveaway. So doing everything we can to get this kind of information out into people's hands. All right, so back to Alibaba, taking a look at the chart here. You guys requested it. We do seem to be playing nicer now with the tariff relationships between the U.S. and China. We'll see what the Supreme Court says about the tariffs. It isn't going to end them. I saw some professors that are talking about other areas of the law where President Trump could enact up to 15% tariffs without Congress's approval. But what it would do is take away his bargaining chip, which is when he threatens the 50 or 100% tariffs. That's what he does to get people to the table to bargain. And if the Supreme Court rules that he can't do that, then take some of the leverage away. And it's going to be a lot slower process, have to go through Congress, all these other things. So we'll see how the Congress ends up ruling on that. But it does seem like, and it's changed quite a bit already a few times, but it seems like the U.S. and China want to come to an agreement. When you look at this pattern, it's a great looking descending triangle. So the bottom line on Alibaba is this about to break out. You do have the wave 4 right at the 38.2% fib level. It's nearing the 50-day moving average. It's in a wave 5 to the upside pattern. Again, you could make a lot of arguments. It's going to break higher. Maybe it does, but I just want to call you back to what Elliott himself said, is that a triangle makes you disregard the Elliott wave pattern. Don't get caught picking a direction based on the Elliott wave pattern when you have a triangle. Any triangle can break either direction. So we do have to respect the possibility that Alibaba breaks lower. Maybe it doesn't. Maybe it breaks higher. But the possibility is there, and if it does, then the support level is down here around 135. You also ask about the XLRE for real estate, and man, that's a boring chart unless you're doing iron condors or calendars or some of the stuff we talked about in the trading for income event that we did a couple of weeks ago. This would be ideal for that. So nice sideways channel here. Interest rates, I think, are going to push people into pausing on home buying as interest rates tick up across the curve. Maybe we wait a little while for prices to come down. If the Fed doesn't cut in December, I think you see another spike up in interest rates. So I think it's going to be challenging for the real estate sector. We're down here at the lower end of the range. You can see what happened last time we broke out of that, but that was the April tariff tantrum. Other than that, we've stayed pretty much range bound. And I think we stay in the lower end, and we could be in danger of breaking to the downside here. I don't see where the catalyst is for the real estate market to go higher now, with interest rates moving to the upside and possibly even more. Maybe the Fed does cut in December and that calms things down, but that's challenging to me for right now. NVIDIA, a lot of people are talking about, NVIDIA is going down because of the government shutdown, because so much of their business is government contracts, along with Palantir is in that same boat. uh, moving down here, but we are testing the 50-day moving average. I just think, again, we got too vertical. We got too far from the 10-day moving average. All the same things that occur time after time after time, which is why I incessantly talk about these rules. So we're right back down. We went vertically up, came vertically back down. We're at the 50-day moving average. We're at the wave 3 high. I think if you wanted to take a shot on NVIDIA, this would be a place. It would be speculative because we are still below the 10-day moving average. Really, if you're more conservative, I oftentimes gives both aggressive and conservative views because we all have different risk tolerances. You know what yours are. If you're more conservative, let it break back above 200, and then you go long NVIDIA. If you're more aggressive, you could take a shot here and see if it at least goes up to 200. But if it breaks below this level, then you're out. You can see that we have this kind of ascending triangle pattern right here that we broke out. We came back. We tested the point of the triangle. So that rule's done. Maybe we don't need to break lower, but if we do, then it becomes a move back to the previous 4. So you've got a real tight stop here if you wanted to be aggressive on it, because any sort of a follow through lower, you're simply out. If you wanted to try to catch a bounce, it may end up being a good short in the long run. We'll have to wait and see how all that plays out. And then AMD, obviously, had a big vertical move, good earnings report, got its AI deal. OpenAI, which generate a lot of these moves. But once again, a little too vertical, a little too fast. So we're coming back down, having a little bit of a correction here, even though they did have a very good earnings report. But you've got to be spectacular. All you have to do is take a look at the chart of Palantir, which had a great earnings report and a great guidance. But, at 82 times earnings, is just, you have to really, really blow it out of the park to go higher from there. AMD, not quite the same valuation, but getting the same result, being a little bit sold off on a decent, pretty good earnings report. Now we see where can it hold. Right in this 225 area where we're trading at the time of this recording is interesting. If it breaks below that, we have the 50-day moving average. I don't necessarily think we come down and fill this gap all the way, but you always have to think about that, because when we take a look at the chart of Oracle, remember when it had its big gap up on its AI deal? Look what happened. The entire gap already filled. We know the majority of gaps get filled. The data shows clearly they do. Not every gap gets filled. Nothing's 100% anywhere. Sometimes they get filled quickly. Sometimes it takes a while, but bam, right back and filled that gap. I don't know that AMD does that, but you have to, think about the fact that I didn't think Oracle was going to fill that gap that quickly either. And perhaps if this corrective move lasts a little bit longer, we go lower. We'll watch 225, watch the 50-day moving average, see what happens after that. And then last but not least, Apple. My goodness, I don't get this. You know that I've perplexed by the market's penchant for wanting to buy this stock. I know it wasn't participating. I know it was a good place to chase performance. I know all that kind of stuff. I just don't understand the enamor with this. Their technology is behind current times, but people love the iPhones. The sales were good. People were ready for a new cycle. All that stuff. As a matter of fact, I still have a suspicion that there's maybe a little bit of stock buybacks going on. Apple has so much money. That's why I've always said it's, to me, the most difficult stock in the entire market to short, because if it starts to go down and you think, okay, I'm doing well on my short, at any point in time, they can decide to buy stock back and create a rush to short covering. So it's difficult to short it. We are at 161.8% extension here on the zigzag. The wave 5 is at 48%, but it's a second extension level that I talked about. Doesn't happen very often. So I find it hard to imagine a scenario where Apple moves much higher. Now, the tap box, the Elliott wave pattern says that we could come higher, but the zigzag, which is the more shorter term intermediate, you can see that's out to April of next year. Maybe it happens by then. But in the shorter term, I struggle to see Apple moving much higher from here. Maybe it doesn't correct a lot, but I think that sideways is the best outlook for that at this point in time. Thanks as always for your attention. Have a great weekend. Please leave a comment, hit that like button. If you know anybody else that you think might like these videos, hit subscribe, and look forward to talking again soon. Take care, everybody.